Welcome to Market Pulse. I am ex-war trader. $1.56 trillion. Let me repeat that. $1.56 trillion. That isn't the budget of a small country. It's not the valuation of a tech giant. It's the amount of money that was wiped off the US stock market in a single day. A financial earthquake that ripped through Wall Street, leaving a sea of red in its wake. What happened? It wasn't a banking crisis. It wasn't a disastrous economic report. It wasn't a natural catastrophe. The source of this chaos was a social media post. A few hundred characters, typed from a single account, were powerful enough to shake the world's largest economy and reignite fears of a war we all hoped was in the past. Who holds this much power? And more importantly, what was in that message that sent even the most seasoned investors scrambling for the exits? In today's episode, we will decode the October shock, peeling back every layer of the event that has the entire world holding its breath. The big picture, a sea of red on Wall Street. Friday, October 11th, 2025. For many, it was just another day winding down for the weekend. But on Wall Street, it was a bloodbath. A day that will be talked about for months, maybe even years, to come. Let's look at the numbers. By the time the closing bell rang, the Dow Jones Industrial Average had plunged 879 points, a drop of 1.9%. It was the index's worst day since May. But that was just the beginning. The broader S&P 500, a much wider measure of the market, evaporated by 2.71%. And the hardest hit was the tech-heavy Nasdaq Composite, which slid an agonizing 3.56%. Both the S&P 500 and the Nasdaq recorded their worst trading day since April. Percentages can feel abstract, so let's put it in cash terms. The S&P 500's 2.71% drop translated into $1.56 trillion in market value vanishing. Into thin air. In a single day. The market had been so optimistic. Indexes were hovering near record highs. Wall Street had seemingly managed to look past tariff concerns, focusing instead on better-than-expected corporate earnings. Things were, as Steve Sosnick, chief strategist at Interactive Brokers, put it, relatively quiescent with an upward bias. He noted in a memo, it was quite shocking to see stocks in a quick freefall. So, what shattered this fragile peace? What turned a promising trading day into a frantic stampede? Epicenter of the Quake, the fateful post. The catalyst was a familiar one. President Donald Trump. On the social media platform Truth Social, he published a short but explosive message aimed directly at China. He announced he was considering a massive increase in tariffs on Chinese imports. He added, "There is no way that China should be allowed to hold the world captive over its rare earth exports." The market's reaction was instantaneous. The post was a lightning bolt that struck at the heart of investor sentiment. It wasn't just a threat. It resurrected the painful memories of the 2018 to 2019 US-China trade war, a conflict that damaged both economies and threw global supply chains into chaos. Trump's threat went even further. He stated that, because of China's actions on rare earths, he no longer saw a need to meet with President Xi Jinping at the upcoming Asia-Pacific Economic Cooperation APEC summit in South Korea. This was an incredibly negative diplomatic signal. Canceling a summit meeting suggests a breakdown in dialogue, pushing the world's two largest economies into a direct confrontational stance. As Ross Mayfield, an investment strategist at Baird, noted, "The ramping up of tensions with China is the big story. It definitely caught markets off guard." But why rare earths? Why could a group of minerals that many of us have never heard of become the flashpoint for a potential global crisis? Rare earths, the ultimate economic weapon. Rare earths are a group of 17 chemical elements. The name is a bit of a misnomer. They aren't actually that rare in the Earth's crust. What is rare is finding them in concentrated, pure deposits. The process of mining and refining them is incredibly expensive, complex, and environmentally damaging. So, why are they so critical? Think of rare earths as the essential vitamins of modern technology. They are everywhere. They're in the smartphone in your hand, in your computer screen, in your headphones. They are a core component of the ultra-powerful permanent magnets used in electric vehicle motors and wind turbines. They are also irreplaceable in advanced military technology, from missile guidance systems to the F-35 fighter jet. And herein lies the problem. China has a near absolute dominance over the global rare earths market. They control about 60% of the mining, but more critically, they control nearly 90% of the processing and refining capacity. This means that even if other countries mine rare earth ore, they often still have to send it to China to be processed. This is the weapon Trump was referring to. By imposing export controls, Beijing could theoretically choke the supply chains of American and Western high-tech industries. Trump's accusation is that China is already slow-walking previous agreements to free up supply for U.S. businesses. His tariff threat is the retaliatory strike, the domino effect, from tech to oil. As news of the tariff threat spread, the domino effect rippled across every sector of the market. The hardest hit group, unsurprisingly, was tech and semiconductor stocks. These are companies that are extremely sensitive to U.S.-China relations. Shares of Nvidia, NVDA, the AI and graphics chip giant, fell a sharp 4.95%. Its rival, Advanced Micro Devices, AMD, fared even worse, tumbling 7.78%. Jose Torres, senior economist at Interactive Brokers, explained it this way. When you have a shock like today with President Trump, they are going to get hit the most because they're the most at risk to the economic outlook worsening or corporate earnings retreating due to a potential slowdown. The market was already worried about the high valuations of AI and tech stocks, making them even more vulnerable to a surprise. But while the market was a sea of red, there were a few glimmers of green. U.S.-based rare earth mining and processing companies surged. USA, Rare Earth, USAEK-AR, gained 4.96%, and MP Materials, MP, jumped an impressive 8.37%. This is a logical reaction. If the U.S. can't get rare earths from China, it will have to turn to a domestic supplier. The chaos wasn't confined to stocks. Panicked investors began searching for safe havens. A flood of money poured into U.S. Treasury bonds. As demand for bonds goes up, their prices rise and their yields fall. The yields on the 10-year and 30-year Treasury notes fell sharply. Precious metals, considered the ultimate safe haven in times of turmoil, also rose. Gold climbed 1.5%, and silver was up 1.2%. Meanwhile, the oil market told a different story. U.S. crude oil prices slumped 4.2%, and Brent crude dropped 3.8%, hitting their lowest levels since May. Why? Robert Yager, a commodity specialist at Mizuho Securities, called it a fear of a demand destruction event. A full-blown trade war would slow global economic growth, which means fewer factories running, less travel, and therefore less demand for oil. Reading the fear, what the indicators are saying. To truly understand the level of panic in the market, we need to look at two key indicators. First is the CBOE Volatility Index, also known as the VIX. It's often called Wall Street's fear gauge. It doesn't measure stock prices, but rather the market's expectation of volatility over the next 30 days. When the VIX spikes, it means investors are bracing for a rocky road ahead and are buying options to protect their portfolios. On that fateful Friday, the VIX soared by 32% to its highest level since June. It was a clear signal that complacency was over and fear was taking charge. The second indicator is CNN's Fear and Greed Index. This index analyzes 7 different market indicators to determine which emotion is driving investor actions. Fear or greed. On that day, the index plunged from neutral territory into fear for the first time since May. The sudden dramatic shift in both of these indexes shows how market psychology flipped 180 degrees in a matter of hours. An uncertain future. Is this the start of a new crisis? After the sell-off, the Dow, S&P 500, and NASDAQ all turned negative for the month of October. The months-long rally seemed to have come to an abrupt end. The biggest question now is, what happens next? Michael O'Rourke, chief market strategist at Jones Trading, offered a sobering warning. The sell-off has the potential to evolve into a larger correction, especially if the U.S.-China trade truce is over. Throughout the summer, Greed has far outpaced fear in the U.S. equity market, and the high level of complacency leaves investors vulnerable. Trump's threat sets up a series of dangerous possibilities. Will the current administration be pressured to take a harder line on China? Will China actually weaponize its control over rare earths, causing widespread supply chain disruptions? And could this confrontation tip a fragile global economy into a new recession? Right now, no one has the answers. The market is in a holding pattern, watching and waiting, hanging on every tweet, every statement, every move from both sides. The October shock has served as a brutal reminder of just how fragile economic stability can be in our interconnected world, and how a trade war, like a smoldering fire, can roar back to life at any moment. $1.5 trillion erased, and fear is back on Wall Street. All from a threat made on social media, centered on a group of metals few know about but which power our modern world. The coming week will be critical to see if cooler heads can prevail, or if we are standing on the brink of Trade War 2.0. Thank you for tuning in to Market Pulse. Be sure to subscribe so you don't miss our deep dives into the events shaping the financial world. I'm X-War Trader, thanks for listening.